Now we're going to pivot over into the international world, and we want to look at futures versus physical, because sometimes I always think there's a bit of confusion in terms of what drives one versus the other. You know, people like to look at one and think one immediately drives the next, and there can be disconnects, there can be differential shifts, there can be some tightness in some parts of the physical market, looseness in another. But you know, the financial market is going to only express their views on the longer term in the futures market, which sometimes can create broader disconnects, and that typically close over time, but they can also, you know, because of the volatility, because of the interest in trading more aggressively, some of those disconnects can last a bit longer. So one of the key pieces that we wanted to look at are some of the estimates. So for those that have been following, the IEA has increased their demand schedule based on China's reopening. We think that's the incorrect take, and we're going to talk a bit about why, just because we don't see too much adjustment up or down, and we're going to highlight different reasons that we think that. And one of the big ones is, as China ramps up, they're going to pull in more crude. That's I think for sure, just based on where they are right now. But it's also going to increase the amount of product they're going to export, because they still have a lot of spare capacity on their export quotas. And you do have more Russian product now coming into the market. So even as China comes up, we do expect some softness in other parts of the Asian refining space. We're seeing more pressure, obviously, in the US on the refining side. And that's going to counter some of those growth projections on the oil demand front. Now, when we look at crude production on the secondary sources, you can see that Saudi Arabia was down 156,000 barrels a day. There was some, but net, there was a reduction of 49,000 barrels a day in production. So again, it's still well below quota, because I mean, the quota, when you look at the, you know, in January of 23, they produced 28,876,000 barrels a day, obviously on estimate, but I'm sorry, million barrels a day. But when you look at it, 28.9 million, they're allowed to do more. And even if Nigeria were to increase production by another 300,000 barrels a day, they'd still be below quota. So when people ask me, well, it's like, well, is OPEC going to cut? It's like, it doesn't really matter what the quota, if they cut the quota, because they're already below it. And there's no reason why West Africa is going to look to increase, given they're going to try to clear that storage. They're going to try to protect pricing. They've gotten a bit better pricing because Saudi raised OSPs. And as we said last week, we saw some term contracts being canceled. We saw a big underwhelming amount of purchasing where Asia took all of their term, but nothing extra. And that's when, and just to be clear, when you take your term, so say for an example, Sinopec buys five cargoes a month. They can also say, we want to buy our 5 cargoes. We also want to buy an additional 3. And then Saudi can allocate where, all right, well, you asked for an additional 3, we'll give you an additional 1. Nobody asked for anything. And that's usually a sign that prices are expensive, there's better deals elsewhere. And that's, I think, an important piece that continues to play out. So the crude production side isn't all that surprising. Now, on the demand front, for 2022, not much change. Again, they're going to try to hone that in. And there's just some slight waffling that'll happen with the fourth quarter. The bigger component is going to be 2023. And here you can see that they have taken higher all of their expectations across Q1 into Q4, taking total 2023 estimates to 100,000 barrels a day higher. IEA is a bit above that, and it's going to be an interesting side in terms of, well, do we really have that demand cycle? And as you can see from China from 2022 into 2023, there is that pivot up. Same with India. Now, there's a likely chance that some of those get increased, but it's going to be very much price driven with Russia. Now, I forgot to include the chart in here, but right now the Russian price on the screens and then actual realized price is much lower. And that's because there hasn't been as much buying and demand, and this is using a blended ratio between Urals and ESPO. because there's been a bit of a slowdown in some of the purchases that we've seen coming from some of their big buyers. Now, it doesn't mean that they're not going to show up next month, because if anything, they're likely to, given the fact that China, Saudi raised OSPs. You'll likely see that tighten a bit. And as we've said last week, when you look at the Russian deal, where they came out and said they're going to cut 500,000 barrels a day, you have to put that into context. Because yes, they're saying they're going to cut production 500,000 barrels a day, but because of the diesel cap, in refined product price cap, they've lost some of the market going into Europe. So that means that there's going to be more refined product that has to get exported. There also has to be more oil that has to be exported. You can't export both at the same time. You only have so many slips. You only have so many ships. So again, there's going to be a limit. And as they've been refining fairly hard, storage is going to climb quickly. So that means that Russia's going to have to cut runs. So if they cut runs, that means that the oil that was going into refiners now has to go into the export market. So they naturally have to cut production, because they can't manage both as they try to dump as much diesel into the market as well as much crude into the market. So that's where there's a view that some of this demand is going to go up. And while China may increase, our view is that other Asia is going to go down, that Latin America is going to go down, that Russia is not going to go up. Instead, it's going to go down. And that's going to be some of that offset, which we continue to see. Now, an interesting piece, and not overly surprising, Iraq put out their official selling price, their OSPs, and you can see that it was a slight increase to minus $1.40, but it's still well below where Saudi is. And I think that's important when you look at Basra Heavy to Asia. They pinned it from at 585 versus 595. Into Europe, they came in a bit, they increased rates a bit. But when you look at OSPs to America against ASCI, you can see that it went from 565 below to 615 below. And this is, again, trying to get a bit more competitive. So yes, rates came up, but it's also the pricing is still below average. And Saudi's above average, if not setting new all-time highs for their differentials. So this is where you're starting to get some of this disconnect, where Iraq is like, look, I see what you're doing, but we need to move this product, and this is some of the best places to move that product and try to get things into the market, because they have to be a bit more competitive, which is something that's going to be a benefit for the U.S. It should increase some of our production, some of our imports, and again, keep some of those elevated coming into the U.S. Now, China's oil imports, you can see, obviously increased, but they're still below some of those pre-pandemic levels. And passenger traffic, when you look at what's happening there, again, it's still just kind of waffling back and forth in terms of airline, in terms of traffic. And one of the key things, and we had this conversation with a client today, yes, passengers are increasing, but the flights, the amount of planes is not going up in lockstep, because these, for anyone who's flown, they're treating you like cattle. I mean, there is no frills. You are just a number. Sit down, shut up, go where you're told. If there's a delay, so be it, because they're trying to shove as many bodies into that flight as possible, because that's where the margin is. Instead of adding back flights, they'd rather cap out each one. Now, obviously, more weight on a plane, more jet fuel being burned. You're going to inherently burn more jet fuel, but not to the same level if you start adding more flights, which is some of that kind of measurement in terms of where things are. Now, when you look at Longview put this out, when you look at some of their estimates, they expect to see crude demand staying fairly flat versus where we were in 2022. And I think I think that makes the most sense when you look at that you have inflation impacting India, with that huge surge to the upside. You still have inflation biting. You still have manufacturing that is actually in contraction. That's going to be a problem. And you continue to see some of these economic data points, again, pointing to some of this slowdown, which is going to be an impediment to demand. Now, they're not showing a collapse, and that's where we are. It's like there is not going to be a collapse in demand because things have already changed. You're already seeing people work from home more, flexible schedules happening more often. In the U.S. alone, 40%, there's 40% less going to the office than previous. You have people that are, feeling that pinch. They're maybe not traveling as much, driving as much. Business travel is not what it used to be. These are things that are going to, again, cap some of that. And then when you look at the economic side in terms of petrochemical demand, refining demand, that's why we look at the products market. The products market is not as tight as the crude market, especially the futures market, is indicating. Now, there has been some tightness a bit on the physical side. Things have been moving fairly well out of Europe. You're starting to see some additional purchase once again. So if you remember, there was some nice purchases closed out January, very beginning of February from West Africa. Big slowdown. Now you're starting to see a little bit of tightness again, and that's driven based on what Saudi did, where they made it where people are not going to want to buy excess from the Middle East. They're going to want to buy that excess from West Africa. And that's why when you look at the Middle East side, you can see that floating storage is still at the higher end, but we see this trending up. Now, Iraq is going to try to clear that out. They raised some of their OSPs, not by a whole lot, because they want to try to maintain some of that flow. And then when you look at U.S. exports, we're sitting at that 3.56, again, 3.56, 3.6. And a lot of that is going into the European market. Now, because of what Saudi did into Asia, we should actually see some support once again for U.S. crude. So we should actually see that drifting back up as we go into March, as we see some of those purchases adjust. Now, the other problem, and that's going to kind of cap how much is going to go, we do see some economic run cuts getting rolled out, and it's going to come by way of maintenance being pulled forward in Feb and early March, which is going to reduce some of that Asian demand because of the product coming from Russia and some of that excess coming from China. So then when we look at diesel demand, diesel cracks, well, here's why. So you had that big spike down, but again, it's still at $25. It's still elevated going back to 2018, but it's well below where we were in 2022. So if you remember, that was the thing that was carrying us. Gasoline cracks were weak. Gasoline storage was massive. Everybody was essentially piggybacking and riding the wave of these gas oil distillate numbers, and now that's giving way because of some of the builds, because of this new product, because of that manufacturing slowdown, which is why we see some of that Asian demand slowing. And even as China picks back up, again, it's that balance between China coming back but others slowing. So net, there isn't a huge demand. And if anything, there's actually more product getting pushed into the market, which is going to keep and hurt some of those differentials. And unless you get a bigger cut in diffs and in the physical market, you're going to have no impetus to come back, because the only way, if you think about a refiner making money, it's either that getting stronger or differentials getting weaker, because you're going to make your margin. It's either because you're selling the product at a higher price or you're buying your feedstock at a lower price. And that's where that balancing act comes through. And it's fluid. We are not saying that we have this crystal ball of saying exactly what's going to happen going forward. But this is an important piece why we talk so much about the refining market and the refining world. Then when you look at the swaps between Dubai and Brent, well, Brent is getting cheap in comparison to previous. It's coming back to the highs from 2021, but that's still much cheaper than we were in 2022 and the beginning of 2023. And as dated Brent gets cheaper versus the Middle East, well, West Africa becomes a bit more profitable, and it makes a bit more sense to buy from there and less from the Middle East. And again, that's some of that back and forth that we're seeing in terms of that balancing, where West Africa is like, well, we can now clear some of this glut that has built back up and try to maintain some of those flows. Now, when we look at crude oil in the water, it's come down a touch. A lot of some of that is from crude going from floating storage onshore, but we do see this staying at a very high level. When you look at crude oil in transit, it's still above where it was, but coming back down, and that's going to create some of the different pivots that we've talked about so far. Now, when we look at crude oil and floating storage, still coming back down, still elevated, but normalizing. And a lot of that is just because supply chains are catching back up. You have, Asia, especially China, coming out of their lockdowns. People are now more mobile. They can speed some of that product coming in, speed up some of those offloads, which is a positive. And again, it's just going to be a matter of also the supply side. The Middle East, how are they going to manage their storage? West Africa trying to manage their storage, because storing on land is cheaper than storing offshore. So if you can avoid putting stuff on a boat, you're going to do that. And that's going to be a net positive for some of those netbacks. Asian floating storage, nice drop. We do have some of that floating storage that will rebuild, but so far our view is we were going to get back to 2022 levels. After this nice drop, it's unlikely we get back to 2022 levels. We think we do get a bounce because there was a nice amount of purchasing that came through China. That's now in transit. That'll show up in floating storage. Again, just timing delays, and that'll put some of that back in. And here's where we are. Some of that super tanker purchasing had that nice little spike, but we're back to where we were, in 2022. And we think we track 2022 pretty closely, because there's a lot of product, a lot of crude that still it extends in the region. And that's where we're gonna, I think, manage some of those levels, which, as you can see, is still at a high end. It's just there's also a lot of product in storage that has to be worked through. So even as they get back to a bit, increase activity, it doesn't mean they're going to increase floating storage or increase purchases abroad as they work through and try to balance what's onshore and what's offshore. And as long as Russian crude stays at the discount it currently is, that's going to stay elevated, but that's also going to be in the gray market. And so you won't see that show up in this number to the same degree as they try to hide some of those purchases. But on a positive note, the China Congestion Index had a nice spike. You had people coming back from Lunar New Year, which ended this previous week. But it's at the tail of multiple cities. Like, where are we in across the board? You can see that there's a nice increase. But when you look at previous, and it's just about that timing, you can see that Lunar New Year was a little bit earlier, so we had a better spike, and then the same drop. And you can see that in 2022 it was slightly later, so we should get a spike. It obviously was very good, but it's going to come back down to that normal level. So even though I think some companies and people are extrapolating this spike as this new shift, and we're saying no, it's good, by no means saying it's bad, but it's just going to come back down to that normal level. It just started a little bit sooner. But one of the key things that we've been talking about and we've been right on is that Shandong in particular, refinery run rates were going to outpace seasonal slowdowns. And that's where we are. We continue to see run rates out. Typically there's the move back down into the 60% range. Instead, we're staying at the 64.5. We think that we have that steady climb because there's the export quotas, there's internal demand, there's some of those shifts. The problem is it's being offset by some of those demand destruction that we've seen in other areas. West African crude oil floating storage, bouncing a little bit higher. That's why some of the discounts have come through. We should see this come back down and stay within the average, which is not great, but again, much better than what it was. And that's going to keep things flowing. And that's why we've seen some of that tightness in the market. I should say tightness, stabilization in the physical market. U.S. crude oil products exports, gasoline staying strong, coming down 157,000 barrels a day, but still below the 5-year, still above the 5-year. Distillate came down 156,000 barrels a day, just below the 5-year. Again, that's going to be kind of managing those flows. Propane, propylene, fantastic number, up 501,000 barrels a day, 745,000 above the 5-year. Again, still staying strong. Crude oil exports bouncing. Again, a lot of that is timing, as we've been talking about. So looking at this, gasoline, as we were saying, we thought the numbers were a little too high, and now it was going to stay within the top end of a cloud above the 5-year average, but below the top end. And again, we think that continues to play out. Distillate, we were thinking it's going to kind of hug much closer to the 5-year. It's still average on a 4-week basis above the 5-year, but again, it's kind of hug that and not have the same type of extremes from the gasoline side. And then crude oil exports, again, kind of bouncing around. But propane, propylene, again, that LPG, nice spike. As we've been saying, it's going to stay to the higher end. We're going to see those flows continue, and that's going to be supportive in general for some of that pricing, why we have a bit of that floor. Now, when we look at Fujairah came in with 17.17 million barrels in storage. That's a drop of 454,000 barrels. And the stock movement saw a drop of light distillate and a slight rise in middle as heavy continued to decline. Light distillate fell 179,000 barrels. The East of Suez gas oil complex strengthened a bit in Feb on firm demand from Indonesia and Malaysia ahead of Ramadan. So again, Ramadan is slated to begin March 22nd this year. Moving forward, Vietnam's February gasoline demand was expected to be supported by last year's, again, Lunar New Year demand as inventories were adjusting. So again, as we come back towards the end of it, we're seeing, again, some of that Ramadan purchase, some of that demand following at the end of Lunar New Year, back to what we were talking about with with China. But as we go forward, again, as some of that catches up, we do expect to see light distillate builds. Middle distillate, small increase of 98,000 barrels. The East of Suez gas oil market was largely range bound, which again kind of fits what we're saying. This competition of new Russian product, some of these exports, as some of that slowing demand kind of rolls in. Lower cracks in recent weeks, regional refiners continue to maximize gas oil production because even though the cracks weakened, it's still the bright spot in comparison to other things, which is why we should see some middle distillate builds, but still stay at a very, very much at the lower end, as we do see light distillate picking up a bit. Asia demand and supply are fairly balanced, even if there is no Western demand, so which is why we're seeing some of those movements. Heavy resid fell 373,000 barrels to just above 8.15. Spot trading activity at the hubs was said to be fairly muted as lackluster demand coupled with steeply backwardated markets. And again, that's why we do see a sizable build in light and heavy in the near term, with middle distillate seeing some small increases, but nothing too major. Brent time spreads, again, strengthened a bit, but still at the weaker end. We don't see that adjusting all that much. When you look at some of the flows, again, Norway increasing into March. You have Nigeria kind of hanging in at about that 1.4. We should see some of those elevated numbers. Angola should hang around about that 1 million. And then Libya is going to stay at about that 1.03, 1.1. as Russia tries to hold close to that 4.6. Even though they cut their production numbers, as we said before, they still have more crude going on the water, and that's what we expect to see. So China took advantage of some of that weakness in dated Brent versus the Dubai, and China bought 5 cargoes of Denago, which is, again, the Congo flow for next month. OPEC expects slightly tighter global markets. So when you look at companies, Unipec has bought about 5 million barrels of Congos for March loading. But as they buy that Congo, which they haven't purchased, it's because they're not buying Middle Eastern. So again, you're getting some of that replacement. And that comes on top of some of the Chinese companies' purchases of some cargoes from the UAE. But that has also slowed a bit in terms of some of the purchases. And then, we had some stable sales for Angola. And now when we start looking at some of the flows in general, West African oil prices firmed on some slightly better margins. Nigeria Bonny Light rose to once $1.62 versus to $1.33 versus 94 to 219, and Q-Ubo from 46 to 149. So again, some nice bumps, and that's going to, that they're also testing to see, well, we cleared some of the flow down here. Is there demand at higher prices? And that's where nothing's crossed there. But again, they're going to test the market saying, okay, well, you bought this. Where are you now? spike it, and then try to bleed back down and find somewhere in the middle, which is likely where we could see as dated Brent has gotten a bit better. So now when we look at Genscape in terms of crude into the European markets, you can see that storage fell again, but there was also some increases in floating storage. So you did get some of that timing delays, but that will help offset some of the builds in the U.S. Just in terms of balancing. When you look at builds in Europe for refined product, nice build in gas oil, nice build in gasoline. The problem is when you look at the gas oil market, it's coming back into balance. It's still at the lower end, but right where we were in 2022. So again, moving kind of closer as they've been trying to hoard ahead of the Russian sanctions. So it's not surprising to see it, moving as much as they can into the market, into storage ahead of that. The question is going to be what happens going forward. We're seeing some tightness again in the nat gas market, the nat gas futures market, and the storage was built on slowing economic growth. And storage is being maintained because of that. Now, what happens when things start to get bigger is going to be the bigger question. Gasoline markets, new record high. Again, this is a big problem, which is why refinery run cuts is going to become a real problem in the near future, especially in Europe, given the amount of gasoline and given the inability or tightness in the ARB market because of shipping rates. Shipping rates make it where, am I going to ship diesel or am I going to ship gasoline? And that's where, again, you're going to ship diesel, and that's going to put more gasoline in storage. Now, fuel oil, again, kind of flatlining, not seeing demand abroad, and a lot of that is because Russian fuel oil is taking its place, which is putting more of this product in their storage. On the Singapore front, small decline. You can see that it's still above the average of the last 18 or so years. Fairly normal when you look at it blended together. Now, when we look at it, it broke into its pieces. Light distillate, still record highs, still the bigger problem because some of this will be absorbed for ahead of Ramadan, the Muslim holiday that goes across a month. But the big celebration is at the beginning and then obviously breaking the fast at the very end. So you're going to see some of those movements, but even with some of that step up in demand, we're still seeing record highs. That's not going away, and that's going to again weigh on margins. We did get a nice drop in middle distillate. Some of that, again, was some of those flows that we've been highlighting. And it's a bit lumpy, and we do see this bouncing, but still staying at the low end. It's going to bounce, but not like it's going to bounce back to the average. It's just going to stay and kind of bump along the low end, which is going to be supportive of cracks, but to what degree? Because the crack spreads softened, then the OSPs went up. So how are they going to try to manage that volume and that margin? Now looking at resid, continues to shift higher, heavy resid moving higher. A lot of that is also because new Russian product coming in, not getting a lot of demand because Russian product is priced at a discount. Some of this is going to get pushed into storage. You're not getting flows coming from Europe. So European storage is going up. Singapore storage is going up, which is why I think it's an easy way to say that Fujairah storage is also going to trend higher. Now looking at North Sea floating storage is at zero. They were typically at this point in time, you can see that seasonally speaking, it normally goes to zero. And now as we will start to see some of this snap back, there was some downtime, unplanned and planned. And then as they come back, you'll start to see that floating storage come back into normalcy. And in Europe, again, kind of waffling back and forth, staying at the average. And again, that timing delay. So we should see some of those builds on the onshore side stabilize a bit. So in conclusion, the physical market firmed up a bit in terms of just where things are, which is why, as we've said, futures are range bound. It's going to stay between, if you look at Brent, unfortunately, the volatility is going to be pretty broad. So between 80 and 86, realistically, we're at the higher end, should see some of that movement to the downside. WTI, similar. It's that narrative of, well, physical markets getting a bit better, getting some decent builds in refined product, especially gasoline. That's going to weigh further on refining activity. as cracks, as middle distillate kind of bounces around, what does that mean going forward? And that's where we see some of that overhang, and why we see kind of oil demand just being fairly stable here at these levels. So that's what we have for you today. If you have any questions, please feel free to reach out. We'd love to hear from you. And we hope you enjoy the rest of your day. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.